The following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. It's Monday here in the U.S. Going to be heading back to Asia, I think, by the end of the week. Oh, yeah. Read that above in the den. I tell you what, we ended up having that event in New York at the Bloomberg office on Thursday, and I apologize for missing the show Thursday and Friday. Was traveling and trying to get that out of the way. But, you know, one of the cool things is that happened out of that event is I guess they liked it so much that they offered us as a company the ability to use these Bloomberg offices for 3 or 4 hour events globally. And that means Chicago, New York, Taipei, Sao Paulo, the whole 9 yards. And they basically pay for everything. So they, have the food and the alcohol and all the fixings, so to speak. So we may have some more of those coming up soon here. And you guys are all invited when we do have those. They're all on Bloomberg. And their hopes in doing this is to obviously expose some of the information and maybe sell some more terminals. So let's get into two major things here this morning really quick. The S&Ps and then gold, because we've got some definite activities here. And I did a research paper 2 weeks ago and sent it to some of our firm deals that we have activity with. And let me just do this. Let me insert a study because I see somehow that my navigator is not on my weekly chart here. Let me pull that up. And there we go. Okay. So one of the pressure points in the research paper, and we talk about this not too often, but it's kind of a slow development situation that I like to look at. Our navigator is almost it has a little bit of lag to it, and that means that this is a weekly situation. It's nothing to day trade off of, in my opinion. I mean, on the shorter term time frames, you can get a lot of use out of it in that arena, but on the longer term time frames, the main reason that I look at this particular indicator is relative to price action. And when we look at this, we have over time had these lower highs that appeared on navigator and higher highs in price action. And we've also been pretty much focused on the other side of the equation with this little feature, this breadth situation. And as you can see, I mean, we are just flirting severely with negative territory on our weekly. And I'm going to show you this here. This hasn't happened yet. We haven't had a weekly close yet. We are just, what were we at? Below 29.12, above 29.94. So as we look at this is our admin version. Our weeklies have just kind of come right back down into, this is what's going on weekend in January 30th, weekend in January 23rd. So we are compressing down. That is a major issue for the S&Ps to have the breadth from our profiles turn negative. We talk about that quite a bit. Can everybody hear me? How's the audio? Okay. Are we okay? Okay. So that breadth turning negative is a major issue for the S&Ps, as that's the case for most of these major indices. And I don't know if you've noticed lately, we've had quite a few of these added as far as breadth goes. It takes a lot of computer power, we're finding out, to do these particular calculations. So we're pretty proud of what this is. And every time we add a few, we've got to add a couple more servers. But just as we look at the S&Ps, we're going to just kind of look at the Shanghai, see that has turned recently. We're going to kind of review that a little bit just to kind of give you proof of concept with this. But as we look back at the S&Ps, this is the situation. It's going to refresh here in just a second. This refreshes every 60 seconds, by the way, because there's so many calculations. There's no way to do it real time. So that being said, and understanding, and I forgot to show you the most important thing I was going to show you. We go back into our daily for the S&Ps. Let me show our daily chart. This has just really been a mixed bag lately. Up and down, positive, negative, since, well, we had that major crossover. Where's the major crossover? Back positive around December 17th, December 18th. And then we've just been kind of a mixed bag. And we've talked about the weeklies and talked about some major inflection points on the S&P chart in general. So how do you use all this? In the research paper, I kind of basically said it might not be time to buy the dips anymore. And that means that, that means that longs and long-term investors should probably have been passing on these type of arrangements now as far as trying to find support, unless we had some major weekly closes above certain inflection points and these breaths really start figuring themselves out and get in the same direction again. But the overhanging bad news is for those longs, in addition to that, is that we've had a divergence happen on our weekly. And we have been breadth positive when we got down to this 1968 general area on the weekly for maximum leverage. And again, I'm kind of being a Monday morning quarterback about this. I'm aware of it, but the same situation had been happening on our daily. So we had higher prices and lower highs on our navigator down here. And now we're flirting below the zero line. And we're sitting around that unfair low on our dailies now, which has been used recently for support around 1988. Now, previously, we had this 1994-70 area, let's call it 1995, and then we had a new profile appears a little bit wider, predicting that we're going to have a little bit, not a little bit wider, but about the same width as the previous profile, which was very wide on a relative scale. Came up and met those targets, rattled around up there, and then we've come back down and found the lower parts of these fair auctions now. So, what do you do now moving to the right of the chart on the S&Ps? In my opinion, you still got this mixed bag here. The weeklies don't look good at all. They look sick on the breadth. You do have still, because the long-term trend, remember, if you go back in time and you kind of look at this standing away from it, the long-term trend really has not been technically damaged, so to speak, trading below profiles. This is our intermediate. But looking at the long-term trend, I'm sorry, I had the wrong chart up again. Here we go. The long-term trend hasn't been compromised since, October, and then we reversed really quick relative to profiles, and I could pull up an SPY chart here for you to see a little bit of history. I think I'm going to do that. And it's a little bit cleaner on the SPYs, and we can get all the history instead of looking at one futures contracts. But if you look back in time, that's a pretty sick situation for the shorts. A couple of times we have been able to have some trading opportunities, and these breadths have actually alerted us of those opportunities, but they've also told us that we are basically on the wrong side of the market relatively quick when we get back into positive breadth action, and at the same time start gravitating back either within these profiles or above. So at very limited times, I guess what I'm trying to say, it has been okay to be short and not okay to be long, but most of the time it's been okay to be long. And I'm going to pull it back up here and pull up our weekly breadth chart. This goes back, I think, to 2009. And as you can see, I'm just going to kind of pull it back to 2012 and take the middle ground out. We've been breadth positive, green line above red line, for most of this time period, and been very short-lived to be on the short side. All right, now that's one indicator that I love and blocks out one side of the marketplace. But as you look back in time, relative to profiles, and the way you use that breadth to trade indices, in my opinion, is you're going to look for inflection points to pay attention to here. And this is the spiders. Let me just go back to ESH5. You're going to look to pay attention to inflection points on the index future or index itself and try to use that breadth to use those battle points to get long or get short. Now, you've got an opportunity here, a mixed bag on the breadth, and Navigator not in your favor. You got a trading opportunity around this 1988-60 area. You've got another one around 1968. Now, these are just battle points that you can see. Obviously, we've rallied off of, and obviously not wanted to be away from there. That's the scary thing. But and we haven't had a close below here. Any closes below here, I think the new range is going to be 1968 to 1988. But to be honest, I'm not opposed to picking a battle here on the long side, putting stops down below for a relatively high risk reward trade, in my opinion. Now, again, that is more of a, see what happens with the breadth here if it's in our favor. Possibly take a look at this Navigator and see if we're going to cross back above zero line, at least on the daily. But right now, if you're waiting for another short opportunity, you got to wait for, in my opinion, a close below 1988. And then that's where more than likely the most leverage is going to be, and then putting stops above 1988. So what did I just say? I said that in the interim, you've got an opportunity here, high risk reward, in my opinion, stops down below. If you get stopped out, you're going to have to monitor this. Remember, if we kind of trail down here and then go back and retest that 88 area on an intermediate time frame, and also hoping that this breadth turns negative on the weekly, that's a very powerful sign. You've got a shorting opportunity here. Okay, so right now, kind of a mixed bag, a little bit of a toss-up. Not the best long indicator situation that we've ever had out there. But those are the big numbers. 88, 68, and 27 are those very strong numbers which we've rallied back into recently. Okay, let's take a look at gold. We got about 30 seconds here before we go to the first break. And if you guys have any questions, please call in. I'd love to. I mean, I don't know if I'm covering sometimes some of the things that make the most sense to you. So please call in. I love getting these calls. I think they're very, educational for everyone when somebody asks a question. And I'll give the number out in just a little bit. Gold. All right, I tell you what, we're going to start covering gold when we come back after the first break, but please call in, folks.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, guys. Welcome back to the show. And I think we have a caller, John from Philadelphia. You there?
John, I am. Thanks for taking the call, sir.
Hey, how are you today?
So, you are such the world traveler. It was New York City last week. Is it the Philippines, North Carolina, or Chicago today?
Actually, down in near Raleigh today, in North Carolina, and it's raining again as usual. But we'll be back in Asia either end of the week or next week, and I'm probably going to spend some time in Hong Kong before I go back to somewhat of a little bit of a home base over there in near Manila. So yeah, I'm looking forward to getting back to familiar territory over there.
Excellent. John, I wanted to ask you if you'd speak to just a little elaboration on
Sure.
gold and silver.
Right.
Specifically, I have a very specific question regarding the price action of gold and silver and what is going on with the daily and weekly figures off your task signal box work. Specifically this. During the month of January, both gold and silver rallied nicely. Silver kind of lagged and then had a burst. And after silver burst higher, out of that 15.5, 16 range up to 18, 18.5, when that happened, I noticed with interest your point of control and top and bottom of the box on the daily for silver moved up dramatically. And then within literally days, John, the price of silver actually came crashing back down. My question is, now that we've seen that price action, and specifically what the figures off of your work had done. Does that tell you something in particular?
Well, it's a great question. And first of all, let's just kind of look at the charts. And if you can, I think we're going to probably go through this deeper than the next 3 minutes. If you can promise me you'll hang around after the next break.
I promise, sir. I promise.
Great. Yeah, well, if you've been watching the show, or if you've been listening to me at all, anybody out there is listening right now, I've not been a big fan of shorting gold, and been, I've got, excuse me, the April contract up. Is that what everybody's looking at right now, or is everybody still trying to migrate out of February?
No, the roll into April should have been done and complete, yes.
Okay, great. Okay, so I've got April up right now. It's J5. So we're trading 1272, and one of the questions I think you had was, we had talked on the February contract, we had talked about 1295 into 1303 being somewhat of a target range.
Correct.
And that was based around some prior inflection points on another long-term profile I'm showing the weekly right now that, was back in the past. But, the longer, excuse me, let me get some, hold on. The longer, excuse me, the longer that we have a profile that stays in force, horizontally speaking, or in, a certain timeline, the more powerful those inflection points really become in that time slot and moving forward. So we look back, on a relative scale to this particular area on the February contract back then, I believe. But on the April contract, we have a similar situation as we should have. And that inflection point area on this particular area is around 1316. So we looked at that, and we also looked at some information on the daily and kind of determined that there was a little bit of a lid up there. Not that there was a great opportunity to short. It was almost just a target-rich environment, in my opinion. And that was kind of after the fact of that breakout of 1200 that we talked about. That was really, really important. I'd also mentioned 1250 as kind of an interim target. And we didn't talk a lot about that, but that was just something I took off half my position around there. So right now, as we see it, just again, sticking with the charts right now and not going into the scanner, we've got a little bit of a volatility situation that happened last week. And as we always look at these, moves up, whatever time, some people are trading on 60-minute time frames, and some people are trading on monthly bars, and it's really difficult to try to cover all those bases with the entire crowd in one fell swoop. I tell you what, I hear the music, John. Can you hang tight?
I will.
Great.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. John, are you still with us?
John, I am.
Great. Thanks for your time today, too, by the way. We were talking about gold when we left, and I think we were talking about, like, what do you do now? And, it was interesting, like, when we were doing that thing or I was doing the thing on Thursday up in New York. I look at people's eyes and their reactions when other people are speaking, and I try to always figure out, like, what's not very attractive to say, and to a way to build the argument that really makes sense, and things like that. And I always, a lot of these people that, get up there and, it almost. Everything they show is almost like the guy always gets the cheerleader at the end of the movie. You know what I mean? It's like everything they everything they say, it always works out, and they show the charts where it always works out, and blah blah blah. And I always get up there and say, okay, what do you got? Give it to me. And people are interested in something that's not canned, and something that's maybe appropriate and real in an environment that's not just some kind of put together or smokescreen. And I really feel that what we have, and like you asking these questions, it's really easy, or once you get the hang of it, it can be relatively simple to kind of block out one side of the marketplace most of the time with this information that we're talking about today. Now, I'm a huge fan some of the things that Tom talks about, and Steve Rhodes and David White on down the line, Basil and all those guys. And I think it's great to combine things, by the way, because I think maybe it was me and you talking about this. So a lot of times, trading slower or not as often will definitely, in my opinion, increase the risk reward scenarios and the probabilities of just not getting ground up by commissions in general, and just kind of being patient. And I think having a lot of those things line up relative to our information is not a bad thing. I mean, I think this thing's and that's one of the first things I tell people when I get up in front of them in the Bloomberg environment. Most of those institutional guys, that terminal's over $2,000 a month per terminal. I mean, you got to have something going on to want to spend that kind of money to do some stock analysis and get some fundamental news piped into you, if you know what I mean. And so one of the first things that I tell them is look, I'm aware that you already, or at least should already have a trading plan in place. I'm not here to have you switch gears, pay new tuition fees to try to learn something that you're probably going to lose a couple of bucks along the way when you switch gears. This is always going to be, for those guys, more of an enhancement, at least from the technical side, to what they're already doing, instead of just having them go, okay, we're going to take our $800 million, blow out all the other research papers and everything else that we're using, and talk to Logan every day. I mean, it's not something that I think is actually smart for them to do, because most of the premises that they were working on before, more than likely, they got some tie-ins to legalities and things like that they've raised the money on. So one of the premises that I always throw out there, John, is that I think that this is almost a good technical roadmap overlay to some things that may already be in place. And that's some of the other guys on TFNN. So that being said, and talking specifically about gold and getting back to it, what should have happened, I guess, and we're going to talk about, what might happen moving forward from this minute on, is as we now, have an orange bar that's appearing on the weekly, that's a warning sign in itself. And we already talked about, those targets before, but let's just say somebody's catching the show right now. Now, on the long-term trade, and people trade on different time frames, that we were talking about, like that bust out above 1,200 on the February contract specifically.
Right.
As we were looking at that particular trade, you're kind of looking at that, maybe trading a little bit lighter, because you want to give this thing some room to breathe, because gold is a crazy volatile thing sometimes, and it will stop you out, as you guys know if you've been trading it. And you have to get stopped out of gold at times, because this thing can, I know you guys already know, it can really move, but it can also kind of do these fake out moves and then kind of go in the direction it was supposedly supposed to, So that being said, we got a warning of a new supply area coming on board on gold back in 126 on this April contract. And I think I could pull up the February contract. It'd be very similar, but let's just stick with the April. Now, that was kind of a possibility, warning sign to lighten up on that intermediate trade. Now, this thing could have rallied straight back up, but what we tell people in our education model that Steve Dahl out of Chicago runs, and he does webinars on this and things like that, when we have an orange bar, that means that the new supply is happening or new demand area is happening, and therefore it's time to lighten up, at least if you've got some money on the table already. Or from a compliance side, I should say, points on the table already, John.
Right.
But then you've got a new profile appearing. Then you can kind of reassess things. And we always talk about, okay, you've got some really good inflection points. So this inflection point, in my opinion, was a buy signal. Now, to possibly add back to that, and lo and behold, we got stopped out. Getting back above here and the close back in the fair auction, that now hopefully will be a close above and retest as we talk about, the closes around these inflection points, and the retests above, from above or from below. So right now, this 1267 area, in my opinion, is to be bought. And we also can look at the 240s, because that inflection point is the most powerful, in my opinion, to pick some battles around. We can also look at the 240s. The first warning sign on the 240s, which, as you can see, that breakout above 1,200 or the relative dollar value of gold on the April contract. We always talk about using the time frame slot below the time frame that you're trading on as a regulator of that particular trade. So the 240, if you're trading off the dailies, and that weekly was the powerful situation, but the dailies, you want to look at the 240s as kind of the regulator. Like, is it still okay to be long and not is it still okay to be long and not okay to be short? Well, that was the case pretty much using this concept up until the stop out on the almost the profile trailing stop up, if you know what I mean, into that 1286 area. Right now, all these inflection points are real time, constantly outputted within this scanner. So don't feel like if you don't have these charting indicators that I've got on my screen, you've also got these most recent situations that are just very apparent sitting. And there's that 1267 we just talked about. There's the weekly new profile attempting to appear, which is, which is kind of nice, actually, in the same vein as the pullback into 1267 again. So, but there's the shorter term time frames. So that being said, what do you do now? And I know we kind of rally back above profiles here, but remember, we had higher highs and higher lows all the way up on these profiles, and then we get something that's a little bit different, and we also kind of rallied back into that 1300 area. Correct. So enough talking about the past. Let's talk about what we do now. So 1272. So right now, in my opinion, you've more than likely, since we're not going to break any serious rules on the 240s here after I say this, and the weeklies are kind of probably going to give you a new inflection point and probably going to tell you that, hey, we've got a new balanced area on the weeklies. I don't think it's a bad idea to look at this 1267 area on gold to try to pick some longs. And this morning we've been as low as 1271. So it would be nice to just sit patiently because we're in a balanced area. We're still, we've kind of gotten back up into it's okay to be long and more than likely not okay to be short situations based on the weekly, no new box appearing yet, and the dailies being back in the balanced area after that little fake out move, which was expensive, to me. That's where I'm at on gold, if that makes sense.
Gotcha. That's very helpful, John, in reviewing the weekly, the daily, and the 240s. Appreciate that. Could I ask you to turn your attention, possibly bring up both the weekly and the daily on the silver? We're trading the March silver presently.
Sure.
And here's what I wanted to ask you specifically. Mm-hmm. The weekly box has remained 1703 low, 1830 high for what feels like an eternity now. And of course, silver was well below that for weeks and weeks, and then popped back up into that, went to, but never closed decisively over the top of the weekly box. Okay, now we're back. Now, so we see that, and we're currently at 1710 and change. We're right near the bottom of the box weekly. Okay. And as you pointed out so many times, the larger the time frame, the more important it can be. Correct. So I'm attracted to the fact that silver has pulled down and is now trading in that neighborhood. So just as a trader looking to work into the potential position trade, I'm looking at all my work, blending it with what price action is doing relative to the bottom of the box. So we're there. Now, having made that observation, and also stating I'm looking to be a buyer, I want to ask if you can then migrate to the daily. And this is where my question comes up due to my unfamiliarity with your work. Okay. The idea is on the daily, there was a top of a box for the longest period of time at 1735. Silver blew over that. And as soon as the daily chart blew over 1735, you almost immediately got a new box, 1850 on the high side, 1772 on the low side. And as soon as that came, or as soon as that new box was established, silver sold off and is now decisively under the low of the daily box. My question to you is the price action relative to the new box on the daily chart that has just occurred for you, in the past week, is this reversal back down? Is that significant? Does that tell us something bigger picture?
It's a great question. And again, there's a lot of inflection points floating around out there, and we got to try to figure out how do we make sense of them. One of the things that the first thing I want to say is we're looking at the March contract. Is that what everybody is kind of dealing with on silver?
Yes.
Okay. All right. So one of the reasons we use the raw data is you can use the continuous contract and you're going to get a little bit different information sometimes, but we use the raw contracts because, and I got to apologize for this, different platforms, and we've got our information on, I think over 10 platforms now, they close, believe it or not, time frames differently on bars, and their data is somewhat different sometimes. And when you factor in continuous contracts on how they treat continuous contracts, and we talked about this, I think, maybe shows a long time ago, they just all treat them differently. And sometimes that data is organized differently. And then we kind of have to deal with our profiles differently. And we end up getting anomalies in the profiles. So what we have done is,
for the purposes of this discussion, why don't we merely assume that the data that you have is the accurate and the only accurate there is, and just go off of that?
Correct. Yeah. I was just, I didn't mean to go off in a left field there. I was just kind of, as I was thinking about it, trying to let people know that why we were using the raw front month futures contract. But I think, okay. So one of the things that was going on here as we were making lower lows on silver, and I didn't talk about this a lot because I just, silver was kind of underperforming gold for the most part while this is happening. But we had that Navigator divergence going on, kind of higher lows on Navigator and lower lows on price action. Yep. And I didn't really focus on that because, I just, there wasn't anything to hang on to down here on the long term. There was no new profiles that appeared. Now, if we had a new profile appear down here on the long term back then, I would have started talking about it, because then I was like, okay, we got some leverage points here, but we just kind of did a moonshot from, the ground floor down here, I guess, of silver. And then we kind of, hit that target, bottom of the profile, backed off, finally got to close above there, and then we met those targets above at 1830. Now, as you can see, the inflection points are, especially in volatile times, are not going to be to the tick. But right now, considering now that we've got the Navigator still doing this divergence situation on the long term, and we've got an inflection point that we've pulled back to in our face, I'm actually looking at 17 as a buying area as we're looking at gold in a relative sense around that 1267 area, John. If you want to hang on, I'm going to keep talking about this, but if you want to get off, I appreciate your time. I hear the music.
John, thanks so much.
Yep.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi guys, welcome to the show, and I want to thank John from Philadelphia that just the great insight and questions and the ability to really walk through these scenarios with him. It was actually reaffirmed some of the things that I was thinking about, and maybe I'll be able to have some deeper convictions about some of these trades, being able to explain it to you guys. But anything can happen, and make sure your stops are enforced when we talk about these particular situations. Now, he was specifically asking at the end about silver, and I tried to use the drawing tools on the bottom here. I can't seem to get them to work on eSignal right now. But one of the things that, recently we didn't talk about this much because there wasn't a lot to hang on to down here when we were down below in the $14 area, and we reached a high of 18 and some change up there, which is what percent move is that in silver? It's like a 30% move in silver in the last 2 months. But the only time we felt really good about this was getting a close above 17 or getting a move above 17 and being able to trade that into 1833. Now, again, if you'd have tried to blindly pick bottoms on silver all along the way down, as somebody might have done around the 14 area, you would have gotten, taken out in a body bag. So we need some confirmations every once in a while is what I'm trying to say, and some deeper conviction. And we missed the large part of that bounce up, but that's just the way the so-called ball bounces. Now, John was asking, what do we do with silver now? In my opinion, since we've got this divergence in Navigator versus price action, we've got lower lows in price action, higher lows in Navigator. I was telling him we were looking for some leverage points down here at any moment to try to pick some battles once we started seeing this situation develop. So now you've got that $17 area. You've kind of closed above, met some targets, come back and retested. In my opinion, because of what I just stated, that $17 area in silver is, in my opinion, a relatively ripe opportunity. And you've also got the situation on the dailies where we've broken down and we don't have that divergence, but that the new target right now on a short-term basis is going to be 17.72.73 for that move up. If that happens, make sure you put your stops below $17, and then ultimately back into that 1830. Excuse me, and getting closes. Excuse me. And getting closes above 1830 and 1850 are going to put silver in a technically very ripe situation that you've never had, or that you haven't had in a long time. Now, why do I say this? That's because right now, and we may rattle around here before that comes to fruition, but as we looked at gold and we looked at that 1266, 1267 area on the dailies. Now, I want to show you something. Oh, God, this is not the right contract. Hold on. J5. Okay. As we look at 1267, this is a similar situation to silver. They don't always trade in tandem, as you know, but you got a support area in gold around the same kind of percentage pullback left as you do on silver. So I'm looking as a buyer of gold at 1267 and a buyer of silver at $17 with stops down below. But the good news is these are longer term inflection points to pay attention to, and they usually provide really good leverage. That coupled with that divergence on silver is kind of, looking very interesting to me, to say the least. Okay, we didn't get into crude. I'm just going to flash it. I know crude's rattling around. I talked about crude during the thing that we did on Thursday up in the Bloomberg office. You've got a new weekly box attempting to appear on crude oil. We talked about the risk was to stay short this thing the past week or two, and that's the case now. The risk, in my opinion, is to try to still sell this in the hole. Now you got to be looking for buying opportunities, and you can find those on the scanner. Any closes above 48.78 on crude are going to be technically damaging for the first time since 100. We'll be right back tomorrow, folks.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.